Welcome to this explainer. Today, we're putting on our financial detective hats to uncover the real economics driving the AI boom, and more specifically, that wild market correction we all watched unfold in June 2026. We are completely skipping past the hype, ignoring the flashy headlines, and doing one simple thing: following the money. We're going to examine the underlying business models, the absolutely staggering infrastructure costs, and the global supply chains that actually make AI possible, just to see if the math really works out.
Okay, so let's jump right into this totally massive number, $2.7 trillion. That's the amount of market value that literally vanished into thin air in just a few days from 9 major AI-linked tech companies back in early June 2026. And we're talking about the heavy hitters here, the backbone of the modern economy. You've got Google, Amazon, Broadcom, Oracle, Nvidia, Tesla, Microsoft, Apple, and Meta. Just to put that into perspective, this wasn't just some bad week on Wall Street. No, this was a financial earthquake that made absolutely everyone stop and reconsider the entire foundation of the current tech market.
You know, for years, the market threw money at companies just for uttering the letters AI. But as Nigel Green, the CEO over at the DeVere Group, really hits the nail on the head, investors are suddenly demanding proof instead of promises. Wall Street woke up, moved away from the hype, and started asking some seriously hard questions about actual tangible financial returns. The whole narrative practically shifted overnight from build it at any cost to, okay, show us the money.
So here's how we're going to break all of this down today. First, the June 2026 AI sell-off. Then unpacking capital expenditure. 3, the $600 billion question. 4, the consumer electronics impact. And finally, 5, historical bubbles and future scenarios.
All right, let's start with part 1, the June 2026 AI sell-off. The damage across the foundational companies of the AI economy was just breathtaking. I mean, Nvidia lost $320 billion in market cap in a single week, right after hitting a $5 trillion valuation. Broadcom, Oracle, Apple, and Microsoft shares all took a total nosedive. OpenAI even quietly delayed its highly anticipated IPO. And what made this so terrifying was a precarious little structural issue. Before the sell-off, just 5 of these mega-cap companies were holding up roughly 30% of the entire S&P 500 index. So, when they stumbled, the whole global market felt the shockwave.
Which brings us to part 2, unpacking capital expenditure.
So to really get why investors hit the panic button, we need to talk about CapEx versus free cash flow. Capital expenditure, or CapEx, is the raw cost of building the engine. It's the money you spend buying physical stuff, like servers, real estate, and cooling systems. Free cash flow, though, that's the actual cash profit left over after running the business and paying for those investments. The crucial link here is ROI, return on investment. When you spend billions on CapEx, your free cash flow totally dries up in the short term. And that means you need a massive future payoff to justify it, otherwise that money is just gone.
And guys, the buildup in spending here is truly mind-blowing. Let's think about the 4 largest hyperscalers: Amazon, Meta, Google, and Microsoft. Back in 2020, they spent about $90 billion combined. In 2025, that jumped to $410 billion. But then, we see this massive, 77% spike in a single year, pushing total projected 2026 spending to $725 billion. Just wrap your head around that. $725 billion. That is more than the entire GDP of some mid-sized countries.
So where is all that cash actually going? It's buying the physical backbone of AI. We're talking millions of incredibly expensive GPUs, like Nvidia's Blackwell chips, which go for tens of thousands of dollars a pop. We're talking gigantic data centers that cost between $10 and $25 billion each. Then you have to wire them all together with specialized optical networking equipment. And because these chips run so incredibly hot, they need their own massive energy grids and heavy-duty cooling infrastructure. It sets up this wild dynamic, right? It's a virtuous cycle for technological capability, but an absolutely vicious cash-burning cycle for corporate balance sheets.
Moving on to part 3, the $600 billion question. The core of the panic comes down to a terrifyingly stark contrast. Big tech is spending $725 billion on infrastructure, but the combined revenue of all major AI model companies, your OpenAIs, your Anthropics, Google Gemini, is hovering around just $75 billion. They're spending nearly 10 times more than they're making in AI revenue. The venture capital firm Sequoia famously called this the $600 billion question. Because seriously, who exactly is going to step up and pay enough for AI to fill that massive gaping hole in the budget?
According to a PEMCO report, this drain on resources is severe. Roughly 94% of big tech's operating cash flow is being totally swallowed up by this CapEx race.
Think about what that means. For every $100 these tech giants earn from their core businesses, which, by the way, are incredibly profitable, they are throwing $94 right back into the AI money pit. That leaves just 6% for everything else: dividends, stock buybacks, salaries, and other non-AI innovation. They are practically betting the entire farm on the assumption that future demand for AI services is going to be astronomical.
There's a fascinating research paper from MIT and Archive that breaks this dynamic down into a simple 4-step funnel. Step 1, buy the raw chips. Step 2, get usable compute online. Step 3, secure actual paid enterprise demand, meaning real businesses integrating AI to boost their own profits. And finally, Step 4, turn that demand into durable free cash flow. Here's the huge bottleneck, though. Wall Street was pricing these tech stocks as if we were safely coasting in Step 4. But the reality? We are totally stuck between Steps 2 and 3, just struggling to get enough corporate clients to actually pay for this stuff at scale.
Let's look at Part 4, the consumer electronics impact. Now, you might be wondering, okay, this is all high-level corporate finance, but how does this actually affect me? Well, the answer comes down to a fierce, invisible tug-of-war in the global supply chain. There is a finite amount of semiconductor manufacturing and memory chips in the world. So every single dollar these tech giants throw at powering massive AI data centers is essentially a dollar of manufacturing capacity pulled right away from the consumer goods we all use every day. AI companies are so desperate for these chips, they'll pay massive premiums. And that means fewer chips left over for your next laptop, tablet, or gaming console.
This collateral damage is exactly why consumer tech giants suddenly had to hike prices on their flagship electronics right in the middle of 2026. The MacBook Air shot up by 18%, the iPad Pro jumped 20%, and the Xbox went up by $150. When Apple was pressed on why this was happening, they bluntly said they had never seen component prices spike this fast. Make no mistake, at the end of the day, you, the consumer, are directly subsidizing this massive AI infrastructure war every time you go to the checkout counter.
Let's wrap things up with Part 5, historical bubbles and scenarios. If history has taught us anything, it's that groundbreaking tech revolutions and massive speculative financial bubbles often happen at the exact same time. Think back to the railway boom in the 1800s. It totally bankrupted countless investors, but it also left behind a permanent transcontinental transportation network. Same thing with the 1990s telecom and dot-com bubble. When that popped, it wiped out trillions in wealth. But you know what? Millions of miles of fiber optic cables stayed in the ground and quietly laid the foundation for the modern internet. Technological truth and investment truth are two very different things. AI can still be a deeply transformative technology, even if its current stock prices are totally detached from economic reality. An MIT economics paper by Ricardo Caballera actually outlines a few ways this could play out in the future. We could see a high capital success where all this spending works out, companies figure out how to monetize it, and we get a permanent, high-capacity AI economy. Or we could see a harsh market correction where the bubble bursts, capital gets stranded, and we're left with empty, unused data centers. Finally, there's a middle ground, a slower spend and monetized scenario. That's where tech giants take a breath, purposefully slash their capex, and let it catch up to the actual realistic demand from enterprise businesses. So I'm going to leave you with this final thought to consider. As this groundbreaking technology continues to physically build the infrastructure of our future, is the math eventually going to balance out? Or are we looking at a massive, multi-trillion-dollar capital misallocation that's just waiting for an epic correction? Keep asking the hard questions. Thanks for joining this explainer, and we'll catch you next time.